If you own an investment property in Australia, or you're planning to buy one, what I'm about to tell you will change how much tax you pay for the rest of your life. The government just tore up two of the oldest rules in the Australian tax system. Negative gearing, the strategy every property seminar has sold for 40 years, is being phased out for established homes. And the 50% capital gains tax discount, the single biggest tax break available to Australian investors, is being replaced with something completely different. This isn't a rumor or a maybe. This is law right now for the 2026 to 27 financial year. And if you're a professional, a contractor, a business owner, someone on a strong salary with super building towards six figures, there's just as much changing for you. New tax brackets, new super caps, a brand new tax once your super balance crosses $3 million. In the next few minutes, I'll walk you through exactly what changed when it applies to you and what to actually do about it. Starting with the part almost nobody has fully understood yet, the property changes. Let's get into it. Quick note before we start. I'm not a registered tax agent, and this is general information based on the law for 2026 to 27, not personal advice. Your circumstances change the answer, so treat this as the map, then take your specific route to an accountant. If you're new here, this channel makes Australian tax and money genuinely understandable. If that's useful, subscribing helps more than you'd think. Let's start with the foundation everything else sits on. Income tax. For 2026 to 27, here's what a resident individual pays. $0 to $18,200, tax-free. $18,201 to $45,000, 15%. $45,001 to $135,000, 30%. $135,001 to $190,000, 37%. Over $190,000, 45%. The real change. That second bracket used to be taxed at 16%. From July 1st, 2026, it dropped to 15%. And from July 1st, 2027, it drops again to 14%. For anyone earning $45,000 or more, that's worth $268 this year compared to the old rate, rising to $536 a year once the second cut lands. Two things stack on top of this. First, the Medicare levy, a flat 2% for most residents, plus the Medicare levy surcharge of 1% to 1.5% if you're a higher earner without private hospital cover. This is the classic surprise tax bill for professionals who assumed their payslip had everything sorted. If your income is climbing towards six figures, it's worth checking whether private cover is now cheaper than the surcharge. Second, the low-income tax offset, up to $700, which phases out and disappears by around $66,667 of income. It's usually invisible because it's baked into your withholding, but it matters if you've had an irregular income year. One more thing, all of this only applies to Australian tax residents. Non-residents don't get the tax-free threshold. They pay 30% from the first dollar up to $135,000, then 37%, then 45% above $190,000 with no Medicare levy. That catches out a lot of Australians working overseas who still own property back home. Super is the biggest legal tax shelter in Australia. Money going in is generally taxed at 15%, not your marginal rate. For many professionals, that's a 20 to 30 point gap in your favor. For 2026 to 2027, the caps went up. The concessional cap, your before-tax contributions, including employer super guarantee at 12% plus salary sacrifice, is now $32,500, up from $30,000. The non-concessional cap, after-tax contributions, is $130,000, up from $120,000, with a bring-forward maximum of $390,000. The catch, your non-concessional cap depends on your total super balance at the end of the previous financial year. If it was $2.1 million or more at June 30th, 2026, your cap this year is nil. That threshold itself just moved up from $2 million, so it's worth checking whether you've moved from one side of that line to the other. There's also a carry-forward rule for the concessional cap. If your total super balance is under $500,000, you can carry forward unused cap space from the last 5 years. Genuinely one of the most underused strategies out there, especially if you've had a lower income year or started earning well only recently. One age rule to know: once you turn 75, only compulsory employer contributions can still go in. All voluntary contributions stop. That window closes faster than people expect. Now the genuinely new piece, Division 296. From 1st July 2026, if your total super balance is above $3 million, an extra 15% tax applies to realized earnings on the portion between $3 million and $10 million, or 25% above $10 million, on top of the existing 15% super already pays. The first balance test is 30 June 2027. If your balance is tracking toward $3 million, just maximize super and don't think about it is no longer automatically the right call. It's worth modeling specifically. Related, the transfer balance cap, how much you can move into a tax-free retirement pension, also rose from $2 million to $2.1 million. Bottom line, more contribution room this year, but a genuinely new tax bracket has entered the picture at the top end. This is the biggest reform to Australian property tax in 40 years, and it landed in the 12th of May 2026 federal budget. Negative gearing lets you offset a rental property loss against your salary or other income. Under the new law, this is being phased out for established residential properties, but only for properties bought after 7:30 p.m. AEST on 12th May 2026. If you already owned a property before that moment or were already under contract, you're grandfathered. Negative gearing continues under the old rules for as long as you hold it, but buy an established property after that cutoff, and from 1st July 2027, you can no longer offset rental losses against your salary. Losses can only be offset against rental income or a future capital gain, though they do carry forward rather than disappearing. Here's the part almost nobody mentions. New build residential property is exempt. Buy an eligible new build, and you keep both negative gearing and the current CGT discount, no matter when you buy. That's deliberate. The policy wants investment flowing into new supply, not just changing hands on existing homes. So the type of property you buy next now carries a materially different tax outcome than it did a year ago. The CGT discount change is even broader. It touches shares, funds, and property alike. Right now, hold a CGT asset over 12 months and you get a 50% discount on the gain. From 1st July 2027, that flat discount is replaced with cost-based indexation, your purchase price adjusted for inflation, plus a minimum 30% tax rate on the net gain after indexation. Crucially, this only applies to gains accruing after 1st July 2027. Anything that built up before then, on any asset, still gets the old 50% treatment for that earlier period. Sell an asset a few years from now, and you could be splitting the calculation into two eras. The family home is untouched, income support recipients are exempt from the minimum tax, and new build investors get to choose whichever regime works out better for them on sale. Picture an investor who already owned a rental before the cutoff. Nothing changes for their negative gearing. When they eventually sell, the gain from before July 1st, 2027 still gets the 50% discount. Only the slice that accrues after that date gets indexed and taxed at the new minimum rate. It's not a dramatic grab on existing owners, but it's a fundamentally different calculation for anything bought after May 2026. For 4 decades, negative gearing plus the 50% discount made property more tax effective than almost any other asset an individual could hold. That combination is now being unwound for established property bought after the cutoff, while staying fully intact for anyone who acted before it or who chooses new build going forward. If you're actively investing in property, the purchase date and the property type are now the 2 most important variables in your tax outcome. A few things specifically for contractors, business owners, and salaried professionals. Division 293 quietly catches high earners. Once your income plus concessional super contributions crosses roughly $250,000, an extra 15% applies to your super contributions, effectively 30% instead of 15%. Check where you sit before committing to extra salary sacrifice this year. Structure matters more as you grow. Sole trader income is taxed at your personal marginal rate with no separate return, but no flexibility. A company pays a flat rate meaningfully lower than the top personal rate. Useful once profits are consistently high, and you don't need to draw it all out. A trust lets you distribute income across family members in lower brackets with more compliance overhead. None of these is universally better. It's a conversation worth having again if your income has grown since you first set up. Deductions commonly missed by professionals: self-education tied to your current role, home office running costs, professional memberships, and income protection premiums. All ordinary, all underclaimed simply because records aren't kept through the year. And if you're still paying off HECS or HELP, remember the compulsory repayment is calculated on your income separately from your regular tax. It rises as your income rises, so it's worth tracking how close you are to clearing it, especially when deciding between a voluntary extra repayment and putting that money into super instead.
Turn all of this into steps you can actually take. 1. Check your total super balance at June 30th. It decides your non-concessional cap, your bring forward eligibility, and whether Division 296 is coming for you. 2. If your income varies year to year, get your accountant to calculate an used concessional cap from the last 5 years under carry forward. 3. If you're buying property, know the date. Established property after May 12, 2026 loses negative gearing against salary from July 1, 2027. New builds keep everything. For if you already hold property or shares bought before the cutoff, you're protected, but expect a split pre- and post-2027 calculation whenever you eventually sell. 5. Check the Division 293 threshold before any big salary sacrifice this year. 6. If your business structure hasn't been reviewed since you started out and your income has grown, put that review on this year's list, not someday. 7. If you don't have private hospital cover and your income is climbing, run the numbers on the surcharge versus a basic policy. None of this requires becoming a tax expert. It requires knowing your own numbers and taking them to someone who can turn them into a plan. So that's the real state of Australian tax for 2026 to 27. A small income tax cut phasing in, super caps that rose but come with a genuinely new tax at the top end, and the biggest shakeup to negative gearing and capital gains tax in 40 years. If there's one thing to take from this video, it's that the biggest cost most people face isn't paying too much tax, it's making a decision this year based on rules that changed 6 months ago when nobody told them. If this was useful, hit subscribe. I'll keep covering these changes as they play out through the year. Drop a comment with which part you want next: super, property, or business structuring, and that becomes the next video. Thanks for watching, and I'll see you in the next one.